Former chairman of the Hong Kong Securities and Futures Commission, Andrew Chang, said speculative capital inflows caused by a flaw in the global financial system contain a negative externality that burdens emerging market economies. Our reporter Akanit Wichiancharan has more on this.
Former chairman of the Hong Kong Securities and Futures Commission, Andrew Chang, said, while long-term inflows in the form of foreign direct investment are desirable, a recent surge in short-term speculative inflows poses a looming threat to the emerging market economies. Capital inflows to Southeast Asia, often in the form of carry trade, tend to be very profitable based on recent experiences. Investors first gain from a positive carry when they borrow in one currency which pays a lower interest rate and invest in an emerging market currency which pays a higher interest rate. Then they gain additionally from the effect of momentum play on the exchange rates, when a stream of capital inflows causes the local currency to appreciate. The 1997 Asian financial crisis demonstrated that if the stock and the property market were to boom as a result of short-term speculative inflows from abroad, the local financial system would collapse when hot money leaves. Hence, a recent surge in speculative inflows puts emerging market economies at risk of a boom-bust cycle. Mr. Sheng described the problem as global gain, local pain. When speculative inflows lead to gains, global investors reap the rewards, but when they lead to banking failure, local governments suffer a financial crisis. Short-term speculative inflows therefore contain a negative externality that burdens emerging market economies. The problem stems from an inherent flaw in the global financial structure. Without a global central bank or a global currency, the global system has no mechanism to deal with such externalities. In an effort to maintain their banking system and economic stability, the local governments are in effect subsidizing speculative capital inflows.
You cannot have global dis-externalities, the pain, as it were, without some kind of mechanism dealing with it, right? You cannot expect a home country to bear all the pain of too much, hot money coming in.
If emerging market economies cannot change the global financial structure, they must create a mechanism to deal with the externalities of global banking. Akanit Wichiancharan, Thai News Agency for ASEAN TV.